Right. Morning, everybody. Welcome to another one of our webinars. This one on offshore investing. Very interesting. There's a lot for us to go through. I'm Nick Brummer, Director at Investonline, and joining me is my fellow director, Stuart, Dyer. Investonline, just a little bit about us. We're a financial planning and investment advisory firm. We're based in Cape Town, Newlands. We're a team of 15. Investonline started 15, 16 years ago, and we've grown quite significantly over the time. Investonline, the name really came from being able to meet with clients, doing video meetings online, so it can be more cost effective, more efficient, and we basically spend more time with our clients. We have our clients are all over the country. Actually, the majority of them are in Gauteng, but we have clients, you name it, everywhere, even a few overseas as well. So, as I said, we're a team of 15. We're 9 planners. So please, if you have any needs around your financial planning or investment advice, please get hold of us and we can help you and do a review for you. Right, that's really my intro. We're going to move on into the presentation now with Stuart.
Thank you, Nick. Good morning, everybody. We've got a very good topic we're going to go through today, the fundamentals of offshore investing. We're going to keep things quite interesting and going through the key points around tax and estate planning when investing offshore. We also talk on some other issues as well. So what we're going to cover is why to invest offshore, what to actually invest in, how one goes about investing offshore, Situs Tax, the hidden risk if you're investing directly offshore, particularly into US listed instruments, the offshore wrapper solution and the benefits of why one would use an offshore wrapper to invest offshore, the nuances between an offshore endowment and an offshore wrapper, a little bit about income tax regarding offshore investing, and then some common pitfalls that we will cover with some other questions that were submitted as well. So firstly, why one would invest offshore. So I think the first main reason is to protect against inflation in the country. So over time, the rand depreciates against developed world currencies like the US dollar. We'll show a chart in a few slides of the long-term depreciation of the rand. And with that, one needs to protect their buying power if you live and your money is invested or you live and spend your money in South Africa. And one way to do that is to invest into offshore assets. Other thing is to gain diversification into other geographies and other economies around the world, and to access global growth. So other listed companies and sectors outside of South Africa in other developed world and other emerging markets, that's really what you can gain access to when investing directly offshore. And often you can do it in a much more diversified way than if you had to buy SA listed companies or funds that had rand hedge exposure. This is just an interesting slide. I think a fair amount of people know this, but it's interesting nonetheless, is that the JSE Stock Exchange, so it's our Johannesburg Stock Exchange in South Africa, as a market capitalization, if you look at the total market cap of the JSE, it's valued at about $1.5 trillion. Compared to the world market cap, which is close to $150 trillion. So the JSE is a listed stock exchange, makes up about 1% or just around 1% of global stock exchange. Funnily enough, if you had to go and buy the All Countries World Index, it's estimated that South Africa actually makes up under 0.5% of that. So we're not even at 1%. So if you're a South African investor and you're keeping a large amount of your money in South Africa, you're not getting nearly, or you're not getting an amount of exposure outside of South Africa nearly as much as you would if you had to just buy an all countries world index, where SA just makes up a very small portion of that world market. This is a rand depreciation chart. Nick, do you maybe want to give us a comment on this chart?
Yeah, thanks, Stuart. Yeah, this is fascinating. So this is the average depreciation of the rand against the US dollar over 40 years. So that's 5.4%. So it's interesting that the inflation differentials, so that's usually the main driver of a currency's depreciation. The inflation differential is 4%. So it's decreased more than the inflation differential. There's lots of different reasons, but one part is the SA, from a risk perspective, becoming more risky. Obviously, our fiscus has got weaker. We've got a lot more debt. So that's essentially, certainly over the last 10 years, which has really got the rand to depreciate even more. But just on Stuart's comments, just about, diversification, investing offshore just gives you a lot more options. And those options are important. And one last interesting thing, actually, if you invested 20 years ago, so over the last 20 years, the JSE and the MSCI World Index have both given a very similar return over the last 20 years. A big part of it is part of the JSE is offshore already. And certainly the big catch-up on the JSE was just over the last year with precious metals and obviously the gold price shooting up significantly. So that really was a big catch-up to the world MSCI index.
Yeah, thanks, Nick. It's very, very good points, very interesting. So if one had to invest offshore, and what you'll notice was we're going to focus primarily on direct offshore investing, but if one wanted to invest in rand-denominated funds, so what rand-denominated funds are is when you buy a rand product or a rand unit trust, and that product or unit trust then invests through asset swap facilities and invests offshore. So an example of this is if anyone's invested in a feeder fund as a unit trust, or if you've got an RA or a living annuity and you're investing into global feeder funds, or you can even these days buy direct offshore shares and ETFs in products like RAs and living annuities. So in that case, you're buying it. In the case of a feeder fund, you're buying an offshore fund, but you're buying a rand version. And we'll explain from a tax perspective why that's important, especially if you're doing that in a discretionary product, not in a retirement product. The other option is just to go and invest directly, and that's really what we're going to talk to today, is if you had to go and buy foreign shares, ETFs, or funds through a global platform. And we'll give some examples of global platforms that this would relate to. And then the third option that obviously there's more options in this, but we're just keeping it quite narrow in terms of what we're going to comment on, is if you had to invest in an offshore wrapper or an endowment. And that is a investment vehicle. An offshore wrapper and an endowment is an investment vehicle that's designed for South African tax residents to invest directly offshore. And we'll cover the benefits and why one would use an endowment or a wrapper. So firstly, just the practical aspects of how you actually get your money offshore. So very good news in this year's budget. This is actually live just of last week, is that you can now take, as an individual, as a natural person in South Africa, you can take 2 million rand per calendar year out of the country as a foreign exchange transfer. So if you've got rands and you're wanting to convert money, invest offshore, for a long time, more than 10 years, it's been 1 million rand per year you've been allowed to do, and they've just increased that to 2 million rand per year. So if you're actually a married couple, you can take 4 million rand per calendar year as a couple. And just to remind everyone, it's calendar year, January to December, and not tax year. And then over and above that 2 million rand per individual, you're allowed to apply for an additional 10 million rand. So that application is fairly straightforward. You just have to do a disclosure of your assets, like one would do in your tax return. If you're a director of a company, or anyone who's doing provisional tax normally needs to disclose their assets. When you do your foreign investment allowance or apply to use your 10 million allowance, you have to do a similar thing. You disclose your assets and you have to prove source of the funds that you're going to be sending offshore. We do this allowance for clients quite regularly. It is free of charge, and generally it takes around a month to get that sign off to then move or to get that approval to do up to an extra 10 million rand per year. And in terms of an actual vehicle that we would use offshore, if you had to or open an offshore wrapper investment portfolio, the minimum lump sum to invest in a wrapper is 500,000 Rand, converted into foreign currency. So it normally works out to about $30,000, or thereabouts at the moment. And then another additional function is they've actually just opened up a monthly debit order functionality for an offshore wrapper. So this is quite nice if you're someone who's still working. You're potentially in your 30s, 40s, or 50s, and you want to be using your allowance to move money offshore, but you don't want to have to potentially save lump sums in a short-term savings and then send the money off as larger lump sums, but you want to do it more systematically. So at the moment, you can do 10,000 Rand a month all the way up to 83,000 Rand a month, which actually gets you to your million Rand. And I expect that 83,000 Rand will double to 166,000 Rand per month. That's a nice way to use your single discretionary allowance and phase your money offshore just as part of your monthly savings, like you would a contribution to a pension fund. Now into the estate planning side of offshore investing, and this is an area where I think rightly so is getting a lot more attention by investors. So Situs Tax, the hidden risk, what is that? So Situs Tax is the US equivalent of estate duty. So estate duty in South Africa is the death tax you pay on your assets. It's in South Africa. I'll show you the amounts now. It's 20% up to 25%. And in America, it's higher than that. And if you, as a what they call in America, non-resident alien, so what you essentially are is you're a non-US tax resident, but you own US listed instruments. That can be shares, any of your US listed shares that you would, pop into your mind, your Nvidias, your Amazons, your Apples, your Teslas. If you own them directly through global platform, any of the global platforms, or you own US listed ETFs directly, you can be seen, or you would be seen, to be having a US estate that would be subject to Situs Tax on your passing. So this is a map that I'm just going to cover. If we just go, let's start at the bottom with South Africa. So in South Africa, you're allowed 3.5 million Rands worth of assets before you pay estate duty, which is our version of estate taxes. Anything over 3.5 million Rand, you pay 20% in tax on the value of your assets. Your assets include your home, your investment assets, any business interests you have. It normally does exclude retirement funds, because retirement funds are handled separately from your ordinary estate. And the top estate tax in South Africa is 25%. So over and above an estate value of 30 million Rand, then estate duty increases to 25%. If we just go over to the left-hand side and we look at America, in the US, that estate tax jumps very quickly up to 40%. So you have to have assets as a non-resident alien, of $60,000. If you go and type that in furiously on your calculator, you'll realize that comes pretty close to about 1 million Rand. So if one had to have more than 1 million Rand invested in US listed instruments, it doesn't have to be done through a US bank. If it's a global bank or even a local stockbroking platform, but you haven't wrapped the assets in any form of wrapper vehicle, which I will cover, but you're just buying instruments directly, such as your shares or ETFs on the New York Stock Exchange, you can be subject to Situs Tax. And on death, the IRS is going to have a claim for Situs Tax on your assets to the value in US dollars. And there's no exemptions between spouses on US assets for non-resident aliens, this term that they call us. In the UK, it's a little bit more friendly. They have inheritance tax. Once again, it jumps up quite quickly to 40%. So both of them are a lot higher than our 20% or 25%. But in the UK, they do give us a higher threshold. You're allowed £325,000. So that's close to around 10 million rand that you're allowed worth of assets before they will tax you. And spouses are exempt. So if you're passing assets from one spouse to another, like in South Africa, that doesn't attract the state costs. So platforms that frequently used by South Africans, there are a few more than this, but I think just some basic ones. Interactive brokers, easy equities. A lot of South Africans are using equities. Often we see for some savings on the side, if you want to buy some ETFs or some shares, just personally, whether you're trading or just buying it to have an interest in the stock market. But something that we are seeing quite commonly is not just having an easy equities ZAR Rand account, but investors opening dollar, euros, and pound accounts and actually using the US dollar accounts to purchase direct US listed instruments. Now, even though Easy Equities is a South African business, you are actually a direct holder in those instruments, and those accounts can be, or those assets can be subject to Situs. So it's just something to be aware of. Here's just a practical example. We just had to zoom in on the Situs example on the right-hand side. So if you had a US portfolio value of $500,000, equivalent of, let's say, 8 to 9 million rand at the moment, you get your non-resident exemption of $60,000. So you would have a taxable US estate of $440,000 at the flat rate of 40% or the Situs rate of 40%. The rand impact on that, let's say around 8 million rand, is almost 3 million rand as tax that has to be paid directly to the IRS by your estate. I haven't even talked about the administration complexities around this, but just as a pure tax impact, and this doesn't have an exemption for spouses. So in South Africa, if you pass away, you pass your assets to your spouse, those assets are exempt for estate duty until the second spouse passes away. If in the case of US listed instruments, no exemption. So that money is going to have to be funded by somewhere, and ordinarily those shares will have to be sold to fund that tax unless you've made plans to pay that tax from elsewhere. So just to go through the offshore wrapper solution, you would have heard us talk about wrappers in some of our past webinars. An enormously popular and beneficial product to South Africans. So firstly, what it gives you Situs protection. The assets are held by the investment institution. So there are a few South African companies that offer an offshore wrapper, and the institution actually holds the assets, which is the shares, the ETFs, or the funds, directly on behalf of the investor. And because of that, the investor is not seen to be a direct shareholder or ETF holder, or whatever it may be, and there's no Situs exposure. Secondly, because the vehicle is set up as a long-term insurance product vehicle, similar to how an endowment is structured in South Africa, you get the benefit of tax efficiency and tax-deferred growth. So what does that mean? Capital gains tax is taxed at a flat rate of 12%, and you only pay tax when you trigger profits. So when you trigger a capital gain, that capital gain is then calculated in foreign currency. So if you've made a profit in dollars, and the vehicle, the product itself, pays the tax on your behalf. You don't have to disclose anything to SARS, and the vehicle pays the tax directly to SARS on behalf at this beneficial flat tax rate of 12%. So you also get the benefit of that tax being deferred, and that you're not paying tax when profit or income is being earned. You only pay tax when you actually sell the investment or make a switch in your portfolio. Thirdly, the estate administration is far, far, far simpler if you have your offshore assets structured within a wrapper. If you've got direct assets, whether it's in the US, Ireland, Switzerland, generally all of those jurisdictions are going to want some sort of representation, often what's called probate. So someone who's going to represent you in those jurisdictions, like an executor would represent you in South Africa. So I know a lot of individuals, they invest offshore and they draft one will, which they would call a worldwide will. And the executors in South Africa will tell you that it's okay to do that because they want to charge you executive fees on your whole estate. But in experience, it becomes very difficult for a South African executor to now deal with individuals in these foreign banks, whether that's in the US or Switzerland or Ireland or any of the other popular jurisdictions. And then number 4 is the structural efficiency that a wrapper gives you. I mean, you can hold within one product, you can hold various contracts, you can own funds, you can own ETFs, there's index funds available, as well as you can have direct shares, all within one product, with all the tax reporting and performance reporting all centralized in one place. So it ends up making your direct offshore investing extremely simple to manage. You can see your returns in foreign currency, and you can manage your tax efficiency. I mean, you actually don't even have to disclose tax. The tax is all paid within the product itself. And we'll talk on the wrapper versus endowment slide about what actually happens when you pass away. But I can't emphasize enough how much simpler it is for the beneficiaries to receive money if those offshore assets are wrapped. So just to kick straight into that and the comparison between a wrapper and an endowment. So both an offshore wrapper and an offshore endowment are protected from Situs Tax. They both have the same tax treatment, and that tax is deferred, as well as you get the flat tax rate of 12% within the vehicle. Now, the main difference between the two vehicles is that an offshore wrapper is what's called a sinking fund. It actually doesn't have a life assured attached to it. And what that means is that the investment continues after the original investor passes away. The investment doesn't mature or end on death. So it has what's called a beneficiary for ownership. And how that works practically is if you pass away and you've nominated your spouse or your kids or whomever it may be as your beneficiary, and you pass away, they can automatically sign a form to take ownership of that offshore portfolio. The portfolio doesn't have to get sold. If they don't make any withdrawals, no capital gains tax is paid at that point, and those assets can continue to stay offshore in foreign currency, and all that happens is they take ownership and take over the account in simple terms. It's very different in how an endowment works. An endowment acts more like life cover, in that when it's got a life assured attached to it, and when that life assured passes, the investment gets sold and gets paid out to the beneficiaries like a life cover policy or life insurance policy would. So I know for a lot of our investors who want to invest offshore, they're primarily doing it as a legacy planning tool and to protect for inflation for themselves, potentially their spouse and their children. So practically they wouldn't want that to be the first money that family members would use on passing, and they don't want that investment to be sold and to be paid out to their spouse or their children. So that's where, generally when you invest offshore, if you invest with us, you can choose which one suits you better. But I don't know what the percentage is, 90% plus will usually pick an offshore wrapper because that money is intended to stay there for as long as possible and to grow for the family. Just around income tax and investing offshore, I'm just going to jump through the slide very briefly, but South Africans are taxed on your worldwide income, which means SARS wants to see your returns around all your income and capital gains that you're earning offshore. So let's just jump to capital gains on the right-hand side. And just as a reminder, so Treasury just increased your exclusion that you get for capital gains per year from 40,000 Rand to 50,000 Rand. But your effective CGT rate, so that's when you trigger a profit, what is the actual tax rate you pay? For individuals, that's up to 18%. And for trusts, it's up to 36%. So materially higher tax rates if you invested directly than if you invested in a wrapper at 12%. And South African trusts can invest in offshore wrappers. You have to have a bit of a mechanism called an asset swap to allow you to take the currency offshore in the name of the trust. But South African trusts can invest in a wrapper, and if all the beneficiaries and trustees are individual persons, natural persons, trusts can also enjoy the 12% tax rate, which is ultra tax efficient for trust to have such a low tax rate as 12%. So that's all the tax and estate content I wanted to cover. Here we've got some questions. We've got 6 questions we're going to go through. The first question is actually about the markets. So with the current conflict in Iran and the uncertainty around Trump, is it a good time to invest offshore or should we wait? So Nick, I'm actually going to ask you to answer that.
Sure, thanks, Stuart. Yeah, tough question. Obviously, a lot of uncertainty at the moment. A lot of news flipping and flopping around. I think the bottom line is, and as we spoke about this about a month ago or so in the Prosperity webinar, is that Trump at the end of the day is really deciding on the outcome of how the US is going to be involved. They started the war, and now how they're actually going to end it or have some kind of off-ramp. So bottom line is that inflation is a big problem here because of the oil price spiking up. And how long will the oil price stay at these elevated levels? And obviously that is bad for global inflation, bad for US inflation. Petrol prices are up significantly in the US, and that's really bad for Trump and the US economy. And obviously there's a midterm election coming up in November, and Trump desperately needs the inflation rate down in order to promote better growth in the US. So the market at the moment is looking through all of this, saying that this war is not going to be protracted, and that we are going to see oil prices coming back down to the levels of around about $60 or $70 a barrel, where they previously were. And clearly, there's a lot of views that this is going to continue, i.e. not the war, but the oil prices are going to stay elevated for a longer period of time. The market doesn't seem to be taking real notice of that. So in short, the uncertainty is there. When should one start investing? It's difficult to time the market. I think if anything, if there was a time for phasing in, this probably would be a good time to start phasing some money in. I think the Rand is in your favor. The Rand has been strong. I certainly believe that the Rand should be a little bit weaker, probably closer to 17 to the dollar. Maybe just above that. So that is in your favor. But a phasing in strategy over a few months is probably the more prudent way of investing offshore, given the current conflict in the Middle East. Right, so is direct offshore investing only suitable for high net worth individuals with high tax rates? Stuart?
Yeah, good answer there, Nick, on the phasing in issue. I think one other thing just on that question is, if you want to take advantage of a seemingly strong Rand, is you can take the money all offshore at one go and then phase in terms of switching into the underlying portfolio you'd want to go into. You don't have to delay the transfer offshore in terms of that timing. So just on this question around is direct offshore investing or let's just say an offshore wrapper only for high net worth individuals with high tax rates? So I must say we get the question a lot around the 12% capital gains tax rate. So the 12% basically is the equivalent of having a 30% income tax rate. And you have to earn around 32,000 Rand a month in South Africa to be at a marginal tax rate of above 30%. And often, if you do have offshore investments, or let's just say equity investments in general, in the years when you then, if the investments become meaningful in size, and in the years when you trigger capital gains, those capital gains events can push you up into higher marginal tax rates than you sit in just from your salary or, let's say, your pension income alone. So if you're someone who's a 31% marginal tax rate person, and you potentially think, well, I don't really need to go into a wrapper or an endowment because I'm not paying a very high rate of tax, but you do have 5 million Rand in an investment portfolio that's invested into balance funds or equities, in the years when you sell and you trigger gains, those gains are likely going to push you up to higher tax brackets, often 36%, 39%, or 41%. And we know the top bracket is 45%. So my answer is no, I don't think you need to be a high net worth individual to be, or be at the top marginal tax rate to use an offshore wrapper or to invest directly offshore. These days, you can do it with 500,000 Rand as a lump sum or 10,000 Rand a month. And I think that the tax benefits is beneficial for most investors. I think it's a great vehicle for anyone who's wanting to gain offshore exposure. Just good question here. How much does an offshore wrapper cost? So offshore wrapper might sound like a new investment vehicle to some people. It's not a complicated product at all. It's not like some of these foreign pensions that are out there, which often have cost structures that aren't very easy to understand and aren't transparent. So an offshore wrapper is a fully transparent offshore vehicle, very similar to if you had to purchase a unit trust or an RA in South Africa, where you get your effective annual cost. There are no upfront fees or commissions to invest. So every Rand you put in or dollar you put in gets invested. And the total effective annual cost starts from anywhere under 1% and above. And what affects the fee? Firstly, is how much you invest, and secondly, what you invest in. So we could obviously give you a much more accurate answer and give you a proposal for anyone who is interested to invest. But just as a starting point, from under 1% plus is what the wrapper does cost you. We think it's an excellent investment vehicle in terms of you're not paying any additional costs to if you just had to invest in a normal unit trust in South Africa, but you're getting all those benefits of the direct offshore exposure, the estate planning benefits, and the tax planning benefits, as we've mentioned. Okay, should I phase my offshore transfer or invest all at once? This ties in quite a bit with what Nick was answering in question 1. So if you're sitting in rands and you're wanting to convert money to foreign currency at the moment, now is potentially a good time to start thinking about moving some money offshore with the rand back under 16.50 to the dollar. It really depends on the individual. You can phase it in if you want to try and see if the rand strengthens a little bit more. Often our view is if the rand does look reasonable and you have conviction on wanting to move the money offshore for more structural reasons, then it's better to just make the transfer offshore. It doesn't mean you have to immediately jump into the market, but you can convert the rands to dollars, and then once the money is in dollars, you can phase those dollars into the underlying portfolio, which would obviously be a portfolio that would match your risk profile. Another very good question. Is it safe to invest all my money in global ETFs, such as US index trackers? This is a very good question, and we have an interesting slide that we'll show you as part of the answer. So global ETFs, given how ETFs work and that ETFs track underlying stock market indices, and in an underlying stock market index, the index is the way it's formed is that it obviously looks at the market capitalization, which market cap is really the total value of all the shares in issue of a company. And the index lists all the companies from biggest to smallest. And an ETF tracks that. So if NVIDIA is the biggest share in the world and NVIDIA's share price goes up more than the rest of the market, then NVIDIA's percentage in that underlying index increases. And ETFs, there's no active management in making a call on if they should buy a share or not. It really just tracks what an index does. So an ETF will, in theory, it's actually buying more of a share as it grows in size within an index, and less of a share as it decreases in size. So our view is that ETFs can have a place, particularly in an offshore portfolio, because they are very cost effective, but it's best to blend ETFs with the right active funds or active fund managers, which we can explain further. This is a big reason for it is, let's just say one invested into a handful of ETFs. And here we've just selected 5 ETFs. You've got your MSCI World Index, your MSCI All Countries World Index. So it sounds very similar to the first, but it includes a wider definition of countries that would be included. Your S&P 500, which is your US stock market, your biggest 500 companies in America. NASDAQ 100, another US index, and then your S&P Technology. Now, often this might look like a silly example in picking ETFs that have quite similar holdings, but I must say we see this quite commonly, that investors do pick a range of ETFs that sound different from one another. And when you actually go and do a deep dive into the underlying holdings, there is a sizable overlap between a large amount of the large ETFs out there. You can actually go and download all the holdings of all of these ETFs online. It's all available freely. And you can actually do an overlap of these funds. But just out of these 5 funds, you can see how the top shares are all pretty much the same in the names. And the only difference is the allocation, the weighting that those companies have within each index. So in theory, in the question was around investing in ETFs leaning towards the US market. We do believe that that does have a fair amount of risk, and that you're having a high concentration in particular shares, and a lot of these shares are in the tech sector or the growth sector in the States, and that we would recommend blending ETFs that, let's say you have a world index with some funds that are more diversified in other areas of the market to take opportunities of more undervalued sectors of the market. And just our closing question, and Nick and I will both go through this, is what are the 5 common pitfalls to avoid when investing offshore? So I think the first one, if you haven't figured that out, is holding US ETFs and shares directly can create quite a headache around the administration, your tax reporting that's due to SARS, as well as your state administration on passing. Using an unsuitable vehicle. So if one doesn't use a vehicle, even if you had to use an endowment or a wrapper, but you use the incorrect one for your wishes. If you're wanting a vehicle that's going to pay to your estate to cover your estate costs, an endowment would be more suitable. If you've got kids who live overseas and you want them to inherit the assets overseas and not have the money have to come pay out to your beneficiaries in South Africa or pay out to your estate in South Africa, then a wrapper would be a lot more suitable. The third point is one I haven't covered, is not planning for estate liquidity. So when you hold direct assets offshore, unless you do it in a trust, those assets are still going to form part of your estate in South Africa. So even if you've got an offshore wrapper, you're still going to have to pay estate duty on that. So if you do have your spouse or your kids inheriting that wrapper, you just have to plan to have liquid cash or capital that's going to be able to cover the estate duty for that asset that sits offshore. So often what one can do is to write in their will exactly what money is intended to cover your estate costs, such as capital gains tax, your executive fees, and your estate duty. Or you can nominate your estate as a beneficiary of the wrapper or endowment to the percentage that makes sense to pay money to yourself, to your own estate, to cover those costs. So you don't have an executor knocking on the door of family members asking for estate duty 2 years down the line after the money's be handed over to them. Number 4 is thinking offshore means only the US. Offshore investing is about global diversification, not just buying a few American shares. I think we've illustrated that in the ETFs we've shown. There's quite a keenness around all the brand names, and especially the tech names that we read on when you read on social media pages these days, our own brands we use. And we certainly do encourage to invest more broadly than just a narrow number of shares. And the final one is chasing performance. I think this is a good rule for all investing. It's not always to look backward at what has done well and assume that trend is going to continue, but it's about understanding the dynamics around markets and being forward-looking. And that's certainly where we feel we can add a lot of value to our investors. Good, Nick. Well, that's everything from me. I'll hand back to you.
Yeah, thanks, Stuart. That was a lot that we went through quite quickly there. You're welcome to please contact us if you have any further questions. But I think it's important. I mean, Investonline has a proven investment track record. We've got 30 years of risk management and long-term results. We're very experienced. All our fees that we charge, which is not a lot, but it's completely transparent, that we set out in all our proposals. It really is a team effort, and I think that's important. We all learn from each other continuously, and then we review our clients. We've got a very, very strict system where we review clients mostly on a quarterly basis or a 6-monthly basis. Often it can depend on the client of how often they want to be reviewed, and we're available all the time. So please, yes, if you do want to get in touch, please, there are details. Our next webinar is going to be on estate planning in approximately a month's time, and please join us there. Thank you very much for joining today.